Hi, this is Stuart Weems, and thanks for listening to the Investopoly podcast. My goal is to give you simple, easy to understand insights, strategies and tips to help you master the game of building wealth. And in this episode, it's a first of a two-part episode on how to structure your lending so that you can save tax. Firstly, it's really important to get good quality credit advice, because how we structure loans and how we fund investments and so forth can have a big impact on the amount of tax that we pay now and possibly in the future when our circumstances change. So we need to have the right structure that accommodates those sorts of changes. So there's 7 tips. I'll share 3 in this episode, and then in part 2, I'll share the remaining 4. So the first one is always borrow the maximum and use an offset. So when we first purchase an investment, be it shares or property, the maximum tax deductible loan is determined by how we initially pay for that investment. So let me use an example. If we go and buy a property, for example, for $200,000, and we've got, say, $60,000 of cash, let's ignore costs, so we only need to borrow $140,000. If we go and do that, borrow $140,000, and then maybe a year later think, oops, shouldn't have put that $60,000 into that property, I actually now want to use it for a non-deductible purpose, like renovating the family home, I might just go back to the bank and say, can you increase the loan to $200,000 and then claim a deduction? The ATO will regard that as 2 different loans, one that will be tax deductible for $640,000, and then a new loan for the $60,000 for which won't be deductible because you're going to use it for your renovating for your home. So you've got to think very carefully about how much you borrow when you first purchase an asset, again, be it shares or property. And my advice is don't put any cash in. Instead, just put the cash in the offset account so that you go and borrow, going back to my example, $200,000, and you put your $60,000 in the offset account so that you're only charged interest on the $140,000, but in the future, you can go and redraw or pull the money, the $60,000 out of the offset account and use it for whatever purpose you want. So you need to crystallize the maximum tax deductible loan when you first initially purchase the property. Number 2, always use interest only. So again, kind of interrelated to the first point, but what we don't want to do is necessarily repay debt. Instead, what I would suggest is offset debt. So put it in a linked offset account. If you don't understand how offset accounts work, just Google it. There's plenty of information online. So instead of reducing the actual loan amount, put it in the offset. It'll reduce the amount of interest that you pay, and you can potentially offset completely 100% of the loan, and therefore you won't pay any interest. But the benefit is that you're preserving the original tax deductible loan amount, so that you can always go back and take the money out of the offset account and then claim the interest, because now you don't have it fully offset in the future. So whereas if you repay a loan, it's gone forever. You can't get it back unless you sort of change the ownership of that investment, which will trigger with property stamp duty and other assets capital gains tax. Number 3 is minimise the security you give lenders. So a really common example is when some clients, they go out and buy an investment property, right? They might have spent a lot of time and hard work repaying their home loan, so they might own their home outright. And they'll go off to the bank and they'll say, look, we want to buy this investment property. And the bank will go, yep, no problem. Here's the loan. We're going to take both your house and the investment property as security. In that situation, you're probably actually better off, and you don't need to necessarily give the bank 2 properties as security. Maybe they can just use your house, for example, and you keep the title to the investment property. I always say that my advice is the best time to borrow is when you don't need it. That's typically when you're at your most strongest, and you should proactively maintain your loan-to-value ratio at about 80%. So if I'm going to give a property as security to a bank, I want the maximum amount of credit, at least credit limit, possible. I might not need it, and I might not intend to use it in the future, but let's lock it in there. At least then I've got access to that capital. If something arises, I can utilise it. So proactively look at how much security does the bank have, and can you pull back some properties, take some properties away and release them? Because the more properties that aren't encumbered, the sort of safer your situation is. So that's the first 3 tips, which is always borrow the maximum, use an offset, only repay interest only, and minimise security. I'm going to go through the last 4 in the next part 2 of this podcast. Until then, bye.